Hey guys, Paul Kolomeyer here, and today we're going to be taking a look at calls. Calls are one of the most absolute basic things in options trading, which is why this is the first episode of Options 101. If you end up enjoying this video, then make sure to drop a like for the YouTube algorithm and subscribe for more content like this. With that out of the way, let's get right into it. A call option is an agreement between a buyer and a seller to buy 100 shares at a certain price. This agreement states that the seller will sell 100 shares of the underlying stock at a predetermined price, which is known as the strike price, on a certain date, which is known as the expiration date, if and only if the buyer wants to buy them. This gives the buyer the option to buy that stock at the predetermined price, which is why it's called options. In exchange for giving the buyer the option to buy 100 shares of the stock at that predetermined price, the seller of the option gets a commission or a premium. This premium is paid to the seller by the buyer. This can seem like a lot to take in, especially for someone who's unacquainted with options, but hopefully by the end of this video you will fully understand what call options are. Now that I've explained it, let's try to look at some made-up examples to get a better grasp of just how call options work. So let's say I'm bullish on Paul Kolomeyer Incorporated over the course of the next week. Then I can buy an option, or more specifically a call option, for $1 a share or $100 total, since there's 100 shares in each option. In this example, let's assume that Paul Kolomeyer Incorporated is trading at $100 and the strike price of this call is also $100. Let's further assume that by the end of the week, my assumption was correct and that Paul Kolomeyer Incorporated would rise to $105 per share. That means that I could buy 100 shares at $100 and sell them to the market for $105. This results in a $500 profit. But you have to remember that you paid $100 to initially enter that trade, which you already paid to the seller of that contract. This means that you, as the buyer of the call, come out $400 in profit in this specific situation. This isn't a bad profit, considering that you initially put down $100 and you profited $400. That's not a bad profit. That's about a 400% profit. Now let's go to the flip side of the equation. Let's say that I'm bearish on Paul Kolomeyer Incorporated and I think that it really won't go past 100. So what I can do in this situation is sell a call for Paul Kolomeyer Incorporated and receive $100 in premium. Let's assume that my assumption was correct and Paul Kolomeyer Incorporated ends this trading week at $99.75. Because this is under the agreed upon price to buy, the buyer of the option would likely not buy the 100 shares from me at $100 a share, since he can simply buy from the market at $99.75 and save money in the process. This means that the option would expire worthless and I would profit $100 that I collected in premium. Both of those examples, we looked at the winning situation for both of the trades. But now let's assume that the trade goes against you. If you are the buyer of the call, then your max loss is the amount that you paid in premium, because if the option expires worthless, then you only lose the amount you paid in premium. This means that while your max loss is capped at the amount that you paid for the premium, your max gain is technically uncapped, because Paul Kolomeyer Incorporated could always go to $500 a share, and that means that you would make a massive profit. On the seller side of the equation, things are very different. You have a max gain, which is $100 in this example, but overall is the premium that you are paid to open up the trade. But your max losses are technically unlimited. This is pretty scary for many people, and this is why many people use more advanced strategies than selling a naked call when they're trying to make money off stocks, or more specifically, options. Now that we looked at fictional examples of how this could play out, let's look at some real life examples of how this could play out. For this example, let's look at Bank of America, pretty big, pretty stable company, which is pretty good for an example. For the options that we're going to be looking at for this example, they are expiring July 17th, and I am recording this video on July 14th. This is important to note as time decay has an influence on option price, but that is something that we're going to cover in a future video. As of recording this video, Bank of America is trading at around $23.90, and the $24 call is trading for 57 cents per share, or $57. If I were to buy the $24 call for Bank of America, that indicates that I'm bullish for Bank of America over the coming week, and that I expect Bank of America to surpass $24 a share. Because I paid 57 cents per share to enter this call, that means that to be profitable, Bank of America has to exceed $24.57 per share for me to make money. If, on the other hand, I anticipate Bank of America depreciating in value or remaining the same, then I could sell the $24 call and pocket $57 in profit as long as Bank of America does not exceed $24, and I will still be profitable as long as it remains under $24.57. So in essence, that's all that calls are, and I hope that I helped you understand what call options are in this video. If you enjoyed this video, or if it helped you understand something that you didn't know before, then make sure to drop a like for the YouTube algorithm and subscribe for more content like this. Till next time.